The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning and warm welcome to Squawk Box Europe. I'm Juliana Tatelbaum here with Karen Cho, and these are your headlines. UBS pre-tax profit jumps 47% in the third quarter, easily beating expectations as CEO Sergio Ermotti tells CNBC he doesn't see signs of widespread credit stress.
The vast majority is of good quality, but of course, maybe there are areas where they are more vulnerable to economic downturn.
President Trump promises positive talks with China's Xi Jinping, telling the APEC CEO summit in South Korea he expects to cut tariffs and strike a deal that will be, quote, welcomed by the world.
You know that President Xi of China is coming tomorrow here, and we're going to be, I hope, making a deal. I think we're going to have a deal. I think it'll be a good deal for both.
The AI trade heats up ahead of today's Fed decision, with Wall Street notching another record high after Nvidia unveils a flurry of deals at its GTC event in Washington.
A very good morning and welcome to the program. Another busy day for markets, everything from the FOMC to big tech earnings and numbers here in Europe. So let's get straight to one of our top stories this morning in Europe. UBS pre-tax profit jumped 47% on the year to $2.8 billion in the third quarter. That was well ahead of analyst estimates, with revenue also rising more than expected. CEO Sergio Ermotti spoke to Carolyn about the results.
I'm very happy that the breadth and the quality of our diversified business model has once again delivered very strong results, because no matter how you look at it, reported or underlying or core results, they're very strong. I think that's almost 20% up on core without excluding one-off items like litigations. So, really across the board in our asset gathering businesses, very strong performance in the US and Asia, Europe, in asset management, with also good inflows, by the way, in wealth management, 38 billion of net new assets in asset management. Almost we achieved or reached 2 trillion of assets with 18 billion of inflows. In the investment bank, our investments in strategic areas where we want to compete are paying off. The IB is up 23%, so gaining market shares again. In Switzerland, we continue to serve households and corporates with 40 billion of new loans or renewed loans. So in non-core legacy, we are making good progress again in taking down cost and reducing balance sheet exposure. The integration is doing well, so we reached 10 billion of cost savings out of the 13, so still 3 to go, but so we are almost there. So across the board, I'm very happy to see the good efforts of my colleagues in the bank paying off.
Let's get out to Carolyn, who joins us now live from Zurich. Carolyn, looking at the early indication, shares could rise about 2% this morning. Help us understand where exactly the bank beat expectations this quarter.
So operationally across the board, it very much beat expectations. For example, if you take a look at the IB, that was very strong, specifically in Asia Pacific. But global banking overall, that saw a record quarter with income up 52%. Global markets not as strong as last year, maybe, but still revenues very strong at 2.2 billion. The income up 14%. Strong equities, FX, rates, credit. So across the board, you saw some pretty good activity. The question is always how much of that can be carried over into the next quarter, into the current quarter. Indications are that this is seasonally a somewhat slower quarter. And the big question also is, on top of that, how are clients feeling about these levels in the markets when it comes to some of that trading activity? That's the question that I put to Sergio Ermotti. In other words, do clients see a bubble?
The issue is quite clear that it's very difficult to find an asset class that is not fairly priced or even more than fairly priced. So naturally, clients are really looking at they are constantly thinking about downside risk, keep a good level of cash on the side to step in when you see corrections, because what we see, although volatility has been quite constant, low, but with big spikes from time to time, and in some cases we had very good opportunity for clients to step in and take advantage of that. So, but generally speaking, diversification is the way clients look at the matter right now, avoiding concentration. No matter how appealing is a sector or a story, being gold or being AI, being any asset class, you want us to really pay attention not to overly expose itself to one of them.
But in other words, your clients, they're bracing for a potential correction.
I think that when you look at, it's fair to say that clients are looking at the current situation, not only from a market standpoint of view, the complexity on the macro level, the complexity on the geopolitical side, basically are leading investors to look for diversification and prudence in certain areas.
Let's talk about some of the cracks that have appeared in the private credit side. First Brands, the collapse, you have no balance sheet exposure, you have fund exposure when it comes to asset management. Do you see any regulatory implications down the road, and do you see a wider systemic issue here?
No regulatory consequences. I mean, for us, for sure, when I look at what happened, it's clearly, although it's very unfortunate when clients, basically suffer losses, they were strategy that were, high yield strategy with full disclosure, no breach in investment policies, and therefore what we are doing right now is to just help, clients to basically contain the losses and get the best out of this. I think that, when you look at private markets in general, they have been growing very much in the last few years. Private credit, which has a very important function in our not only in the asset allocation, but also in funding the economy. The vast majority is of good quality. But of course, maybe there are areas where they are more vulnerable to economic downturn. We haven't seen an economic downturn, a significant one, for a while. So we're going to have to see how these asset classes perform in such a scenario. But in general, I don't see any sign of stress across the board that would make me, busy or thinking about a problem.
Sergio Ermotti there, the CEO of UBS, talking to me a short while ago. And when you talk about UBS, you always have to talk about regulatory capital. That's always front and center. Obviously, the Federal Council wants UBS to hold an extra $26 billion in capital. UBS has repeatedly called this excessive, has been lobbying very hard to bring that number down. What I'm reading, what I'm hearing is that there might be a bit of a compromise forthcoming. But again, that process will take over the next 2 years to unfold. So this is basically capital that is still sort of trapped within the company. This is how one analyst points it out, Barclays that is. JP Morgan, on the other hand, says, well, if there are higher capital requirements, the company has a lot of time to phase that in. It sees no concerns whatsoever in terms of fulfilling any extra capital needs, and saying at its 1.6 current tangible book value, it is definitely undervalued compared to some of the peers in the market like Morgan Stanley. Back over to you.
Carolyn, thank you so much for the breakdown and for bringing us that interview. I know we've got a lot more to talk about with UBS later in the show, but we've got to push on because it's a big earnings day on both sides of the Atlantic. We've got GSK numbers crossing the wires in the pharma space, a strong set of numbers from the pharma giant. GSK delivering strong Q3 performance and upgrading its 2025 guidance. A lot of the strength coming from specialty medicines. You're also seeing strength in vaccines and general medicines, but overall, specialty medicines up 16% over the period, sales coming in at £3.4 billion. And in terms of the guidance upgrade, 2025 turnover growth of between 6 to 7% now projected Previously, the guidance was toward the top end of the range of between 3 to 5%. So meaningful upgrade there. Core operating profit growth of between 9 to 11%. Previously, the guidance was top end of the 6 to 8% range. So big upgrade there as well. And then finally, core EPS growth also upgraded in terms of guidance, 10 to 12% now forecast. Previously, we were looking at toward the top end of the range of between 6 to 8%. So meaningful guidance upgrade here. And just a reminder, we are looking forward to a CEO change at the top of GSK. And on that note, Emma Walmsley noting in today's release, I'm delighted to be passing the baton to Luke and to be leaving all that GSK has to offer in such good hands.
Let's push on to markets. No doubt a lot of commentary about it being a red hot market. And we saw that full display yesterday. US markets, fresh record across the board, a hat trick again. Take a look at the Dow escalating another 1/3%. So the range is a little bit smaller on some of these charts. And you can see on the S&P 500, the Nasdaq much firmer in the past month. If you look at some of the ranges, very much a melt up thanks to technology names. We've seen that displayed from the semiconductor stocks to the more momentum names in technology. So the Nasdaq again out in front, a bounce of 0.8%. And it was Nvidia again leading the charge. So the market looking at some of the innovations coming through from the semiconductor. Don't forget, we've got the big Mag 7 tech names still reporting this week. I want to take you to what we're seeing elsewhere, because it is the Fed decision that international markets are closely watching. 25 basis point rate reduction that could really juice the markets. And we're not just talking about US stocks, internationally as well. Trump, of course, has been conducting this Asian tour as he looks to wrap it up in South Korea. You can see these markets are bouncing. Japanese stocks, very firm outing ahead about 2% and well and truly clear of the 51,000 handle at this point. Shanghai stocks, the market again waiting for any glimpse of a breakthrough around trade negotiations that has bolstered the fortunes of the Shanghai Composite. And South Korea, where the president is today, the Kospi is very strong, 1.75%. US futures, the early picture, this is how we're looking at our European futures. We are chasing a bit of a mixed picture, and those US futures giving us again a glimpse of further green to come later on today, Juliana.
Well, in terms of what's ahead, a big focus, of course, on the FOMC decision. We're counting down to the Fed rate decision later today with a cut all but certain. Traders are pricing in a 99.9% chance of a 25 basis point cut today and a near 90% chance of another move lower when the Fed meets in December. Policymakers are reckoning with a lack of official economic data due to the government shutdown. The one data point they did receive, September CPI reading, came in softer than expected. That, combined with concerns over the labor market, has driven expectations for cuts, with easing expected to continue into next year. Now, away from the rate decision, the Fed could use today's meeting to end a 3-year phase of quantitative tightening, a move that could ease pressure on the banking sector after Chair Jerome Powell said this month that QT would end in the coming months. Well, when you think about the tailwinds that have been propelling markets higher from here, I would put Fed rate cuts right up at the top of the list. Clearly, there's been a huge amount of hype around the AI trade, but so much of the rally we've seen in markets is pinned on the Federal Reserve cutting interest rates into a pretty decent growth environment. But the Fed seems to be more concerned about the slowdown we're seeing in the labor market than upside risks to inflation, even though many economists say we are going to see an uptick in inflation. It just hasn't come yet.
I'm going to bring out Goldilocks because the storytelling today suggests that the porridge is a little bit too cold, that the Fed will be cutting at this stage because it is worried about some of the elements that it is seeing. But the reality is you can bring out all 3 different types of porridge scenarios at this point. We've seen a lot of hot porridge, and that is the market furor around AI trading. That is a huge boost to financial markets that we're seeing right now. Goldilocks, as some are seeing, that's fairly even trajectory. Well, in fact, we haven't got an inflation problem necessary to worry about. Growth is still chugging along fairly nicely at this stage. So some would almost see the middle scenario versus the slightly colder porridge that is requiring a rate cut today. What is somewhat lumpy in the equation is the lack of data and the lack of visibility here. I mean, we're 29th day into the US government shutdown, and suggestions that then next month we're not going to get another read for the US Fed to dissect in terms of some of the inflation numbers. And if there is even a resumption of the government, then it would take another 6 weeks catch up for a full set of data to come through. So you've got a Fed trying to make an assumption here about what it's seeing, whether it's appropriate to cut rates. But the elements we're seeing, it's really just a stab in the dark, isn't it?
I think that's absolutely true. It's remarkable to think that the Fed is going to be making such a pivotal decision with so little data to hand. And when you think about what we have heard, we haven't heard on the data front, but we have heard from corporates over the last couple of weeks on the jobs front. We've seen some pretty huge cuts coming through, in part on the back of AI. And that's an important factor in the labor market here. When you're talking about Amazon cutting 14,000 jobs, Target cutting thousands of jobs, tens of thousands of white-collar workers now being laid off into a labor market that has already shown to be stagnating. That is a difficult predicament for the U.S. economy. And clearly that's on the Fed's mind here when it comfortably talks about the importance of addressing the labor market weakening at the same time being a little bit more relaxed about the inflation picture.
The point you raise is one that there's more complexity coming to the labor market at this point in time. That in fact we've got some huge structural changes, and it is the AI story, and you've got a lot of employers trying to work out what they need for the future. But there's also the migration story, a very tight approach that the US administration has run against immigration. Means that you've seen a natural workforce really stripped back. And that has had implications on the hiring side, but also on the unemployment side. And I think it is a Fed trying to work out just how finely tuned, how finely balanced that US labour market is, whether it is still close to full employment, whether there are fractures. And to your point, I think having data at this stage would be highly relevant for the central bank. Well, for more on what to expect from the Fed and what its QT decision could also mean for markets, don't forget Michelle Bowman has wrote into that fairly broad-ranging debate. You can head to CNBC.com.
Coming up on the show, should Europe have one major stock exchange? We'll discuss the proposals of the CEO of Euronext after the break. Plus, President Trump continues his trip in Asia as he addresses the APEC summit, CEO summit that is, in South Korea. We'll cross live to Sherry for more details this hour. And don't miss our interview with the CEO of Santander as the lender reports an 8% jump in third quarter net profit. That's coming up at 7:30 GMT.
German Chancellor Friedrich Merz has called for greater stock market integration in Europe in order to allow companies to avoid what he described as a fragmented market when pursuing a listing. Last week, I caught up with the CEO of the London Stock Exchange Group, David Schwimmer, at an IIF panel on the sidelines of the IMF World Bank annual meetings, and I asked him what he thought about the idea of a pan-European stock exchange.
If Europe were to have one stock exchange, it would be pretty clear which one it would be. I think, and I'm including the UK in Europe, of course, there. I think that the issue underlying the question is the concern about the levels of liquidity and access to capital in different markets around the world relative to the US. That's sort of the fundamental underlying issue, and that's what drives that kind of policy discussion. I think there is an opportunity to have greater consolidation among exchanges in the continent. I don't think that LSEG would be considered in that for political reasons. And I think that could end up being helpful in terms of attracting more capital and concentrating liquidity in one particular platform.
Well, David Schwimmer really putting it on the tee for us as the Euronext CEO Stefan Buchner joins us now, who says he welcomes proposals for greater consolidation and joins us to discuss more. Thank you so much for joining us. You just heard the reaction there from David Schwimmer, effectively saying it would be pretty clear which exchange it would be. I would assume Euronext, wouldn't it, if there was to be consolidation?
Well, as of today, Euronext trades 25% of the equity traded in Europe. Just to give you an order of magnitude, the aggregate market capitalizations of companies listed on the Euronext single liquidity pool, single European market is above 6.2, 6.5 trillion euro. The aggregate market capitalizations of companies listed in the London Stock Exchange is around 3 trillion. The aggregate market capitalizations of companies listed in Frankfurt is below 2 trillion. So the single European Euronext market is twice the size of the London stock market, and is about 3 times the size of the Frankfurt market. So we have aggregated the single liquidity pool, the single order book, the single technology platform that is probably the basis for the aggregation of further consolidation. But we are where we are also because other stock exchanges in Europe have decided to, I wouldn't say walk away from equity markets, but to consider that there are better growth opportunities. You know, the reason why equity markets are less important in London and within the London Stock Exchange Group than they used to be is also related to the fact that the valuation multiples of the London Stock Exchange Group are much higher since they have decided to diversify away from that particular segment. So what we are observing, and the comment of the Chancellor is very interesting, is that there is an aspiration for from leaders who want to have a sort of full food chain of equity, savings, investment, capital markets on the one hand, and on the other hand you have operators, market infrastructures that have decided to diversify away in data, in post-trade, etc. Euronext, for historical reason, remains closer to equity markets. We believe that our purpose is to power capital markets to finance the real economy, to connect local economies with global markets. Other exchanges very often, in particular the ones with much higher valuation multiples, have decided that it is not the purpose anymore. So that's why there is a debate between the aspirations of leaders, and we are more connected with the aspiration of European leaders because of this commitment to the financing of the real economy.
A not so subtle swipe at the London Stock Exchange, LSEG, which has gone after data services and seen a very strong performance as a result of those data services business. But if there were to be consolidation, if Europe was truly to go towards a single stock exchange, would there be any choice for LSEG but to join in or be left behind?
Well, I mean, M&A is a consenting adult game. So owners...
Or a lack of other options.
Which is another form of consenting. They would have to build their strategy and to decide what they want to do. One thing is clear, we are available for any form of consolidation. There was a time when London was the largest financial center in the European Union. With Brexit, London has decided to become the largest financial center of the United Kingdom. But it's clear that you can't fight geography and you can undo history. Equity capital markets in London used to be the core of the European capital markets. So if at some point of time there is an appetite to consider that consolidation, of course will be available.
So you would consolidate with LSEG if you could?
Well, but it is not a question of us being a willing buyer. It's a question of whether there is a willing seller.
Stefan, let me change tack here and ask you about some of the trends we're seeing in markets. I hear day in and day out how difficult daily trading has become because there's so much volatility intraday. And the FT this morning put out a really fascinating stat, and I'm just curious to get your take here, that individual stocks have gained or lost more than $100 billion in market value in a single day, 119 times so far this year. That's the highest annual total on record. So in other words, we're seeing huge price swings in stocks. Partly, obviously, that's because companies are getting bigger, stocks are getting bigger. You're now looking at some massive mega caps in the US, but it also surely is a reflection of the fragility in sentiment here. How worrying is that to you, and what should we read into that kind of intraday volatility?
I think this is one symptom of the fragmentation of liquidity. What we have observed over the past 10 years is a fragmentation of the liquidity pools and the multiplication of systematic internalizers, of dark pools, so the question is not the competition with the MTF and other lit venues, which is fine and okay and good for everyone. The question is that the amount of liquidity that is distracted from lit and transparent single order books into bilateralization. So the liquidity in lit markets is not as deep as it used to be. We are compensating that through all sorts of programs still, and I think volatility is one of the output of this fragmentation. And supervisors should be reminded that when in the sort of permanent fight between increasing competition, which is good, versus fragmenting markets, which is bad, they need to find the right equilibrium between concentration of liquidity within a certain competitive environment. If you go only through competition, you get to huge fragmentation and collapse of the quality of price of reference prices. If you want a single price, you get to the monopoly years, which is none of us wants to have. So defining this equilibrium between fragmentation, which is acceptable, and competition, which is tolerable, is the key issue for supervisors. And the point you are raising, in my view, is one of the symptoms of this difficulty.
Can we get an update from you on what you're seeing in terms of flows between Europe and the U.S. investor allocations? It's always great to hear what investors are doing based on what you see.
No, what we have seen since Trump took office is two trends. One is a slow move of U.S. money injecting to Europe because Europe is cheaper than the U.S. in terms of valuation multiples and safer in terms of rule of law, in terms of predictability of the environment. But what is more interesting is the amount of money from the rest of the world, which is pumped into the European markets because of the fact that the Trump administration has triggered a sort of reset reboot of the strategic allocation, of the global strategic allocations in Asia and in the Gulf. People realized that they were too much concentrated on US risk. And when you want to diversify in developed economies, Europe is appearing as a good ratio between the return, risk and yield.
Stefan, can I ask you about the froth that some people think we're seeing in markets? The reality today, it's Fed day. The market thinks that we may see a Fed cutting into what is still a growth cycle at this stage. There's a huge AI investment play happening. We've got a lot of reaction to trade deals that President Trump is embarking upon now across in Asia, namely the big China relationship. Do you think there's froth emerging in markets at this stage?
I don't know. I'm very.
You've seen many cycles, though. You must have a.
No. I've seen many cycles. I've seen some technology cycles. I'm skeptical with the. I do basic maths with AI. I don't see how we can close the loop in terms of investment, expected return, the sort of assumptions behind the underlying growth behind those investments. So at the very least, even if it is not the end of the cycle, at the very least there will be discrimination between some losers and some winners within that particular sector, assuming that the sector doesn't collapse. At least that should trigger some attention within the sector. And for sure, we should have a much more disciplined approach of indices. You guys should show your numbers on those on Nasdaqs, including and not including the 7 Magnificent, because those aggregate numbers do not make any sense.
Yeah, the equal weight.
So that in this respect, the issue is to what extent the valuation of the 7 Magnificent reflect option 1, the fact that we have become global tax collectors on the rest of the human beings who buy their stuff in the planet, or their valuation is not reflecting the proper growth prospect, because like every single one of us, they will be facing their own technology challenges and market structure challenges.